All right, this journal entry process. 3 steps. Let's review those 3 steps. First, we answer 3 questions. What accounts are involved? What direction did they go? And what are the amounts? 1, 2, 3. Once we've got that done, we use the code of debits and credits, which we're getting pretty good at, I think, now. And finally, we just combine it into that accounting statement and accounting sentence that summarizes exactly what happened in the journal entry, with the debit first, the credit second, with the credit label and the amount indented a little bit. Those are the 3 steps. You think you got that? Okay, let's try one more. Scary. Take a look at that. We sold inventory to a customer for a total price of $75,000, but on account means they didn't pay us now. They promised to pay us later. We're going to record it, but we didn't get any cash. The inventory that we gave them cost us $60,000. So we're getting a little complicated here. Let's see if we can figure this out. What's involved here? Well, I'll tell you what's involved. There's no cash involved, but there's an asset, accounts receivable. Well, this AR here stands for accounts receivable. But the asset inventory also is involved because the inventory is now in the customer's truck driving away. So the inventory is also involved. Why, by the way, did somebody promise to pay us $75,000? Because we did something for them. We gave them some inventory. We created this $75,000 asset, this accounts receivable asset through doing business. That's revenue. What kind of revenue? It's sales revenue. We didn't do any lawn care for them. We didn't do any consulting for them. We didn't earn any interest here. We did some sale. We sold them something. So it's sales revenue. But there's an expense involved, and we know that expense is called cost of goods sold. So let's figure what's what. What went up, what went down. The asset, accounts receivable, just went up by $75,000, but that's partially offset by the fact that my asset inventory went down by $60,000. The revenue, remember revenues reflect the amount of assets created through doing business. Well, they just went up. Revenues just went up by $75,000. But my expenses also just went up. The cost of goods sold expense just went up by $60,000. That's part of the cost of doing business. Got revenues, got expenses. Let's convert this into the debit and credit language. Accounts receivable went up. That asset goes up. That's shown with a debit. The asset inventory goes down. We show that with a credit. Revenues, since revenues are equity accounts, and revenues mean that my equity just went up, we're going to show that with a credit to show that equity went up. Expenses, on the other hand, are also equity accounts. I'll write right over the top here, and my equity went down. More expenses mean less equity. So I debit expenses. I always debit expenses. I'm going to say it again. Well, yeah, but I debit this asset, and that's something good. It is good, but debit doesn't mean good. Debit means debit, left side of the page. When I'm talking about assets, a debit means the asset went up. When I'm talking about equity accounts, like cost of goods sold and expense, that means equity went down. Now, let's put this in a pair of journal entries. Please, when you sell a product like this, do it in 2 separate journal entries. One to record the revenue, the other to record the expense. If you do it like this, you'll never go wrong. The asset, accounts receivable, goes up. We show that with the debit, $75,000. Where did that asset come from? It was created through doing business. That's revenues. And revenues are always credits because they represent an increase in equity. Wait, are revenues sometimes credits? No, they're always credits. Inventory went down. That's easy. The asset went down. That's shown with a credit. Why did it go down? Because that inventory is now in our customer's truck driving away. So this debit to cost of goods sold, this expense represents the fact that my equity went down. We reduce equity with debits. More expenses mean less equity. When you go to sleep tonight, I want you to be saying to yourself over and over, more expenses means less equity. We do it with